Good morning, everyone, and Assalamu alaikum. Thank you for joining us today. With less than a month left to go, we are running a repeat session of a repeat webinar of the one held before Eid. We are also going to be running the same webinar in Arabic next Tuesday, the 9th of June, and details of the Arabic webinar will be sent out later this morning. Your presenters today are myself, I head up the tax team at Keypoint. We've also got Mark Gamble, a senior manager, and Dawhan Hung, a manager in the VAT team. We also have as panelists, Omar Hisham and Raman Ori, both senior managers, and who will be available to answer any questions through the webinar and also at the end. In today's webinar, we will discuss what the rate change means for businesses and importantly, what you should be doing now to be prepared. Please feel free to ask any questions using the Q&A tab at the bottom of your screen. Before we get into the webinar, let's look at the wider picture first. The decision to increase the VAT rate seems to be a direct result of the impact low oil prices and COVID-19 have had on the Saudi Arabian economy. So can Saudi Arabia change their VAT rate? The standard VAT rate was specifically set in the GCC treaty and requires the member states to agree to any changes. However, ultimately, the VAT laws are implemented at the country level, and it looks like Saudi Arabia has taken the lead on changing the rate. So we expect that Saudi will soon release an amendment to the VAT law and also regulations to affect the rate change. What will Bahrain and the UAE do? UAE has said that it has no current or immediate plans for a VAT rate increase, and Bahrain has not made any official announcement. Given all GCC economies have been hit hard, it is possible that they may also consider a VAT rate increase. What are Oman, Kuwait, and Qatar likely to do? The current expectations are that they would apply 5% VAT on implementation. However, should UAE and Bahrain follow Saudi Arabia and increase their rate to 15%, it may make more sense for Kuwait, Qatar, and Oman to follow with 15%. GAZT has already issued the transitional rules, and we will talk about this in more detail shortly. They've also issued an FAQ, which is in Arabic and which Keypoint has translated to English. So if you need a copy of the FAQ, please contact us if you haven't already received one. With less than a month to go, there's not much time left to get ready for VAT, for the VAT rate change. So we recommend that businesses, if they haven't already done so, to start making system changes, to start reviewing contracts, and so on. Before we move on to the rest of the webinar, I just wanted to flag also the customs duty rate changes that have occurred recently. So just a few days ago, the Saudi government has also announced a number of changes or number of increases to custom duty rates. The increases range from 0.5 percentage point to 20 percentage point increases and cover a wide range of products. The customs rate increase coupled with the VAT rate increase is likely to have a significant impact on the price of goods and services for consumers. Businesses that import goods should consider the impact of the increased duty rates on their cash flow and also ensure that goods have been appropriately classified for duty purposes. The rest of the presentation is going to look at the issues to consider as your business gets ready for the VAT rate increase. Businesses with a presence in Saudi Arabia will need to be very diligent with their VAT processes and compliance, as a 5% error was generally small and immaterial, but a 15% error is going to be significant, as are the penalties that will be imposed. The increase in VAT rate is particularly relevant for exempt suppliers, as VAT will become an even bigger cost to them. Exempt suppliers will be unable to take advantage of the grandfathering rules in relation to contracts, or will only be able to take them in relation to the supplies that they acquire that relate to taxable suppliers. Also, all businesses will need to carefully look at their blocked input tax. You may need to make significant system changes to cater for the VAT rate change. If you're in the retail sector, you will need to amend prices and your margins may be affected. Your contractual agreements will need to be reviewed. For example, is the VAT rate of 5% hard-coded in your contracts, and what are the implications of doing so? You will also need to look at your continuous supplies. For example, what is the treatment of supplies of goods and services that straddle 1 July, and also what straddles 1 July 2021, because there's also a cutoff date of 1 July 2021 as a transitional measure. So I'll pass it on to Mark and Han to run through the rest of the presentation.
Thanks, Mubin. So the rate increase will have an impact on a number of areas of the organisation. So it's very similar to VAT implementation. So it's not only the finance function, but it has touch points across the whole organisation. So starting with the finance team, obviously impacts cash flow, could be a potential additional cost, especially if you're making purchases from non-registered persons or making exempt supplies. You'll need to look at revising budgets. If you are an exempt or a mixed supplier, you'll be particularly hit hard by the increased costs because you can't get that input tax recovery. And obviously a higher VAT rate means higher potential penalties for non-compliance. So whichever person in your team that looks after VAT and VAT compliance now has an increased responsibility, because if they get it wrong, the penalties are going to be high.
Just to add another point, businesses may require additional working capital because now that the VAT rate has increased, you will probably need to, in certain instances, you will need to pay VAT upfront. Therefore, you will need more capital, working capital in your business. So this should also be taken into account for budgeting purposes. Obviously, coupled with the fact that some of the items, the customs duty for some of the items have increased as well. So all this have to be considered in your budgeting.
The marketing and sales team will also have an impact. So customer contracts will need to be reviewed and amended as necessary. And if you're selling to non-registered persons, obviously the cost is going to increase for them. So you need to consider, are my customers willing to pay the increased costs?
Quick one, Mark. Is it worthwhile to inform customers now regarding the rate hike?
I think if you haven't already started informing customers, you should do now. Obviously, we've less than a month to go. So the more notice customers have about the potential increase to their purchases, I think the better. And that's just I guess a customer relationship point. Staffing. So you'll need to consider, do I need to hire more staff to adequately deliver my VAT compliance function? So at the moment, you might have a person doing the VAT return that has a number of hats. So they're doing certain other activities in the finance function. Given 15% is a higher rate and a higher compliance risk, do I need to hire someone that just takes care of VAT? You'll need to consider, can my AP team process invoices quickly as possible? So perhaps you could get away with delaying the input tax recovery a few months. But now with 15% VAT, you want to try to recover that input VAT as quickly as possible. So there's a couple of ways to do it. Obviously hire staff, but you might want to consider outsourcing a component of your compliance, VAT compliance function as well.
So from a system perspective, you'll need to amend or reconfigure some of your ERP or IT system that interact with VAT reporting and data gathering for VAT preparation purposes. So a couple of things that you need to consider. It would be the vendor master list, the customer master list. You probably need to update your tax codes and potentially new general ledgers if you want to. You will have to update your VAT rate. And now we understand some system is unable to cater for 2 different standard VAT rates. So you probably need to consider a stopgap solution in this case. You need to update your VAT documents, which we will discuss later in the session. You need to perform a user acceptance test. You need to also look at your open POs and sales orders. So some of the practical considerations that you should have in mind when you prepare for this would be, how does it impact your financials? Have you done an analysis, a detailed analysis? Is your system able to cater for the change requirements? And if not, what are the stopgap solutions? Do you have the capacity to review and make updates before 1 July, considering we are running out of time? Do you have sufficient internal resources to comply with VAT going forward? now that the rate is 15% and therefore the penalty is much more significant. Should you engage an external advisor to review a VAT return? Will your staff need training for potential updates and changes made to the legislation or the VAT return reporting format? So those are some of the points that you should think about when you are preparing yourself for 1 July.
We'll go through some specific industry-based issues shortly, but we'll just start with some general concepts that are applicable across most, if not all, taxpayers. So the first point, and perhaps the most time relevant, is the transitional issues. So what do I do with my sales and purchases that span the period of 1 July 2020? So is it 5%, 15%, or a mix? We'll go through the transitional rule guide that's been released by GAZT in the next few slides. But this, I think, is probably the most important thing to look at now. System process updates. So Dahan mentioned this. You'll need to obviously update your tax codes for this 15% VAT rate. We know from experience with clients that some systems can't cater for both, for a standard tax rate to be 5% and 15%. So you'll need to discuss this with your systems team and those that are updating that to make sure you can get an adequate stopgap in place if your system can't do that. If you're in the retail sphere, you need to display prices inclusive of that. So obviously that will need to be updated. If you have a point of sale system, you need to make sure the updates are flowing through that system as well. And obviously once you've updated your systems, you need to test it. So if you haven't made a start yet, time is running out to obviously update and test.
Just to add on the point of sale system, some of you may have sales via handheld devices, so you need to consider the interaction between the handheld devices and your ERP system as well as the goods return for handheld devices. So those are quite common for retail sector. So on historical data, you need to consider how does the system interact with the new and old data according to the new parameters or configurations set. If different ERP modules are used, how easy it is to extract different sets of data and how complete it is. So all this you have to basically test it out. If you have any data extraction issues, you will need to consider and you need to identify and fix it. From a VAT documentation perspective, obviously you need to update your tax invoices, simplified invoices, credit notes, debit notes. Certain businesses should cater for 2 instances where 2 rates need to be shown on the same invoice, or alternatively, you can issue 2 separate invoices, probably. You probably also need to set up proper debtor monitoring procedure. On liaising with the customers, the question is, can you pass on this cost to the customer? You will need to probably conduct an analysis on this. Do your contracts allow for the rate increase? What does the contract says? Can you discuss with your customers to increase the VAT charges? Now, it should be fine for fully taxable customers, but you probably face resistance from mixed suppliers or customers who make mixed supplies, because such requests will have direct implication for them, as this will be part of their VAT costs. On contracts, you need to perform review of long-term contracts, which includes both sales and purchases, specifically in the wordings in relation to VAT, to see if it allows businesses to top up the VAT payable by their customer. For example, if the contract uses the word prevailing rate, then it should be fine. In contrast to specifying 5% VAT will be added to the price quoted. From a cash flow perspective, you will need to review your cash flow projections and your margin. Previously, it was based on 5%. Now, obviously, it's on 15%. You also have to think about how does it interact with your contracts? Does it allow you to increase your VAT charge? If it's not, obviously, it's going to affect your margin. You explore the possibility of delaying your upper tax liability based on the time of supply rule. You reduce your invoice processing procedure to speed up your input tax claim process. Probably you need to be more aggressive in following up for incompliant invoices from your suppliers. From a process and procedure perspective, you will need to update those that has interaction with VAT. Now, depending on the system capability, as previously mentioned, so more steps may be required to be added in order to extract different sets of data or consider more manual processes in order to prepare a VAT return. So you need to put in place proper process and procedure for transitional purposes. You need check and balances as well. So consider the rate will be going up to 15%. This means higher compliance risk, and therefore it might be useful for you to have all this in place. Typically for businesses in other high VAT rate jurisdictions have a dedicated VAT function to look into VAT, as the potential penalty will be substantial due to high VAT rate. And this is especially the case for mixed suppliers, for example, the financial institutions, insurance companies, real estate companies, and etc.
Okay, so now we will look at the transitional rules that that apply across the obviously 1 July period, and I'll throw over to Mabeen now to go through the examples.
Yeah, thanks, Mark. So GAZT released the transitional rules just prior to the Eid break. The transitional rules consider pre and post 11 May 2020 contracts. The reason for using 11 May as a date is because that's when the announcement happened. So 11 May is the cutoff. So the rules look at both contracts as well as pre and post 11 May invoices. The GAZT also issued an FAQ in Arabic. If you want an English translation of the FAQs and you haven't received it from us as yet, please send us an email and we'll send it to you. So the rule in relation to government contracts, for contracts entered into prior to 11 May 2020, 5% VAT will continue to apply until the contract renewal date, expiry date, or 30 June 2021. Now, an interesting question that comes up is, what does contract renewal mean? Now, a lot of clients have been asking, for example, if they make a change to one of the terms of the contract or there is a price change, does that mean the contract is being renewed? Look, I think you'll need to look at the terms of the contract and what, for example, clauses in there to allow for a change to the terms of the contract. Now, generally, if it's within the contract and it's a price change or something that's happening that the contract allows for, we wouldn't see that as a contract renewal. So it should just continue. So contract renewal would mean basically the contract's coming to an end. Effectively, it's an expiry or the contract is being renewed for another term. So that's what we would need to look at. But again, you have to look at it on a case-by-case basis. For contracts entered into between 11 May 2020 and 30 June 2020, if the supply is completed on or before the 30th of June, you will charge 5%. So you will need to carefully work out if the supply can be completed before this date. For continuous supplies, obviously there'll be some transitional rules issues that you will need to look at, or apportionment issues, sorry, I should say. There may also be pressure from your government customers to have goods supplied or services completed before 30th of June in this case. From 1 July 2020 onwards, you charge VAT at 15%. For contracts with taxable persons, again, there's a similar rule. So contracts entered into prior to 11 May 2020, you need to determine firstly whether your customer can fully recover the input VAT. If so, you can continue to charge 5% until the contract renewal, end of the contract, or 30th of June 2021. So you will need to ask your customer whether they can fully recover input VAT on the supply that you're making and get this confirmation in writing. If your customer cannot recover the input VAT in full on the supply, the transitional rule will not apply to the contract and you will need to charge 15% VAT for tax points after 1 July 2020. For contracts entered into after 11 May, effectively if the supply is completed on or before 30th of June, you can charge 5%. So again, you'll need to carefully work out if the supply can be completed before this date. From 1 July 2020 onwards, you charge 15%. Now, if the contract rule doesn't apply, you look at the invoicing rule. Mark, can you just move to the next slide, please? The invoicing rule slide. Thanks. Invoices issued before the 11th of May, but where the supply is taking place on or after 1 July, you can apply the 5%, provided the supply is completed before the 30th of June 2021. Okay, so that's the important condition there. Invoices issued after the 11th of May, again, if the supply is completed before the 30th of June 2020, you can charge 5%. And if you, from 1 July 2020 onwards, you charge 15%. So now, it's great that the GAZT has put out the transitional rules. However, the application of the transitional rules is unfortunately not as straightforward, and they do raise a number of issues. So we'll talk through some of these issues. I mean, one of the first issues is the apportionment for continuous supplies that straddle the cutoff date. Mark, would you like to sort of discuss some of the issues that we're seeing that businesses will be facing with this?
Yeah, so with this issue, obviously the confusion is that from 1 July 2020, 15% VAT applies. But then what happens when you've got a contract that's signed before that, but it's delivered continuously over that period? When should I start charging 15% VAT? So the rules that obviously you just went through, Mabeen, are ones that you should go to and look at. And it's about ascertaining when did I enter that into that contract, and when are the services under that contract going to be delivered. So in often case with continuous supplies, there will be a requirement to apportion. So that's I guess a manual exercise to apportion the degree of the supply that's made after the relevant cutoff date. So that's the apportionment issue. Process and documentation for transitional invoicing. So the guide obviously helps a lot with this, but for example, with an invoice that could have both 5% and 15% on it, how do I show that? And what is the format of that invoice? I think is an open issue at the moment.
I think it's also good.
Sorry, if I just step in there, I think it's a very interesting point, because a lot of businesses have asked us the question, if they are issuing an invoice now and they know that the supply is actually going to be made after the 30th of June, can they charge 15% on the invoice now? I think the simple answer is no, you can't issue an invoice with 15% right now. You actually have to issue an invoice with 5%, even though the supply is occurring after the 1st of July. And then you will need to do the transitional invoice in July. And the invoice will need to be set out in a particular way, showing the new 15% and what's been charged previously and what's been paid and what the balance owing is. So yes, there'll be a lot of issues around this transitional invoicing process.
I think it's also good to consider goods and services return as well on the second point. We are all worried about how invoicing is going to look like moving forward, but retrospective returns will be important as well. You need to probably have a proper check and balance in the whole process to make sure the correct VAT rate has been applied in your credit notes. You probably need to consider a strict 4i review in terms of issuance of credit notes as well. So they work both ways. You need to consider both sides as far as the transitional is concerned.
I think as well, this point kind of makes it really important now to get on top of the communication with your customers, because if you're issuing an invoice now that you know should be subject to 15%, but you can't issue the 15% now, obviously issuing the 15% after is going to raise a bit of confusion. So obviously important to start communicating this with your customers now. Another point, interaction between the contract rule and the invoice rule. So the slides Mabeen just went through. So we have three different rules. So the government contracts rule, the contract rule, and the invoicing rule. And it's understanding how each of those rules kind of interplay with each other. So which one should I look at first? And then when do I apply the invoice rule? So there's some points there that I think people are getting a bit confused on at the moment. Evidencing the requirement that customers can claim input tax in full. So a key element of the contract rule, in order for it to apply, is that the customer must be able to fully recover the input tax on their purchase. So as a supplier, you won't ordinarily know what your customer can recover So you'll need to ask them, and then it's about obtaining that evidence, perhaps a declaration or something in writing to evidence that. A common question that's jumping up a lot, and I had a quick look at the Q&A, I think it was touched on there, is a purchase order a contract? And how do I deal with purchase orders? So I think this is an interesting question. I think it's probably more of a legal, contractual question as to whether your purchase order can satisfy the requirements of being a legally binding contract. So I think it's something you need to look at on a case-by-case basis.
Look, our view would be that if you've got a purchase order and it contains all the terms of the basis on which you're supplying to your customers, there's acceptance, there's offer and acceptance, and everything is in there, then I think you can treat a purchase order as a contract as well. So, but as Mark said, it's a case-by-case issue. You can't automatically assume that a purchase order will be a contract, but it can be a contract that satisfies the requirements. Now, we'll have to wait for GAZT to issue any other guidance, because all we have is the transitional guide. They are going to issue or changes to the regulation, so we'll have to see whether there's any other particular requirements that they put in place. And also just going back to the previous point about the requirement that customers can claim input tax in full. Now, it's important to note that you shouldn't automatically assume that. So if you're supplying to a customer who is a fully taxable business, they don't make any exempt supplies, you shouldn't automatically assume that you can charge them at the 5% rate, because the supply that you're making to them could be subject to there could be blocked input tax on that. So you've got to look at those kinds of issues as well to see whether the supply that you're making to them, can they recover the VAT in full on the supply that you're making. So it's very important to get that correct. Now, another point that's come up is invoicing in installments, and we've had a number of issues with this where you've issued an invoice pre-10 May or on or before 10th of May for part of the payment. Now, if you've only issued a part payment invoice, only that part payment can be at 5%. And if the rest of the supply is happening after 1 July and the invoice is issued after, or sorry, even if the invoice is being issued after that date and supply is taking place after 1 July, then 15% is going to apply. Another issue, Mark, you may want to talk about this, is what entities qualify as government?
Yeah. So we're getting a few questions, particularly, I guess the key example is probably Saudi Aramco, whether that qualifies as government. So our view is that it doesn't qualify as a government department or a government entity. So you really need to assess who your contract's with and come to a conclusion as to whether they're a government entity. Moving now to, we'll go through 3 examples, which I think are helpful because they show how the transitional rules work. So our first example is a long-term contract between 2 businesses where the services are delivered on a progressive basis on a monthly basis. So our example covers cleaning services, but this could equally apply to any continuous supply. So it could apply to maintenance services, landscaping services, anything that's delivered on a continuous basis. So in our example, the contract has been signed before the 10th of May, so before the announcement of the rate increase, and it covers the period from February 2020 to February 2022. So it's a 2-year contract. The recipient of the service can fully recover the input VAT on this supply. So that point is obviously relevant for applying the contracts rule. So the contract here is valued at 180,000 reals and is subject to VAT 5% of 9,000. The contract is invoiced in full in February 2020 when the contract is signed.
So what are the VAT consequences? So as we have a contract between 2 businesses, we first apply the contract rules applicable under the transitional rules. So the rule states that if a contract is signed before 11 May and the customer can fully recover input VAT, VAT will be chargeable at 5% until the earlier of contract expiry, renewal, or 30 June 2021. So here, the contract expires in February 2022, so the relevant cutoff date for the 5% VAT is 30 June 2021. Therefore, 5% will be applicable until 30 June 2021, and from then on, 15% VAT will be applicable. In the second example, the example number 2 concerns a supply made by a business to a customer who cannot recover VAT. So includes an unregistered customer or private individual. The example covers a supply of single good, which is a car. So it is a discrete one-off supply. This example can apply to any discrete supply made to private individuals. For example, majority of the retail sales, and any one-off services provided to individuals, for example, a house painter. So here, a car is sold to a private customer for 150,000 reals before 10th of May 2020. The invoice for the full amount is issued in April 2020. The car will be delivered in August 2020, so therefore it's after 1 July 2020 cut-off date. In the April 2020 return, the supplier would have recorded a sale of car valued at 150,000 reals with a VAT at 5%.
So what are the VAT consequences of this transaction? So when we apply the transitional rules, we look at, as it's an individual unregistered customer, it's a B2C arrangement. So that means we apply the invoicing rules. So here, the invoice was issued before the 10th of May, and as the supply is completed on the delivery of the car in August 2020, which is obviously before the 1st of July 2021, you can charge VAT at 5% on the supply. So the supplier does not need to make any adjustment. But if we change these facts very slightly and say that the supply completes, as in the car is delivered after that 1 July 2021 cutoff, so say in August 2021, as this is a discrete supply, it's a one-off supply of goods, the VAT on the supply would need to be calculated at 15%. So the supplier would need to issue an additional invoice to charge and collect the additional VAT that's owing. The third and final example that we have is a situation where you have multiple invoices issued for one supply. So you may have issued an invoice to collect an advance payment and will later issue an invoice to collect the balance that's owing. This example involves a sale to a non-VAT registered person. So again, we're not looking at the contracts rules, that we're looking at the invoice rules. Here, a vehicle was sold in April 2020, valued at 200,000 with a VAT at 5% of 10,000. The vehicle will only be delivered to the customer after 1 July 2020, but before 30 June 2021. In April 2020, the customer paid an advance payment of 10%, so 20,000, with the balance owing on delivery of the car.
So what are the VAT consequences in this? So when looking at the transitional rules, as it is a B2C arrangement, we apply the invoice rules. These rules say that if you invoice before 10th of May 2020 and complete the supply before 1 July 2021, 5% VAT is payable. If you issue the invoice after 11 May 2020 and complete the supply after 1 July 2020, 15% VAT will be applicable. So in our example, the supply completes on delivery of car, which is before 30 June 2021. So the VAT rate applicable will depend on when the invoice was issued. The invoice for the advance payment or the advance amount was issued before 10 May 2020. So this amount will be subject to VAT at 5%. The invoice for the balance will be issued after 11 May 2020. So this amount will be subject to VAT at 15%. So it's important for you to identify and apportion the VAT and the amount correctly to make sure the right VAT rate is charged to your clients.
So we'll look now at some specific issues that are applicable to various industries. So starting now with the impact on retailers. So from a commercial and a systems point of view, the retailers will be impacted pretty heavily by the change in rate. So we've identified a couple of issues that we think are relevant, but obviously you should conduct a more broader review of your operations. So rebates and discounts, and this goes back to the transitional rules. So if I'm offering a discount to customers in July, but it's based on sales made in Q2, what VAT rate do I apply? If I receive a rebate from my supplier in July based on Q2 sales, what is the VAT impact? So it's just about understanding the interplay between activities conducted after 1 July 2020 and the impact it has on activities conducted before the VAT rate increase. Obviously, returned goods is another issue that retailers will have. So what VAT treatment should I apply to goods that are returned? Do I need to monitor the date that they're returned and whether they relate to sales made pre or post 1 July? And obviously, your systems will need to be able to cater for this as well.
So from a pricing point of view, you will need to amend your display prices. You probably need to amend your contracts as well and review your contracts. From a cash flow perspective, what will the impact be on stock purchases? Is it better to stockpile prior to July? For free gifts, you need to assess your impact on deemed supply. Obviously, when VAT rate increased to 15%, your cost of free gifts will go up. On vouchers, you should consider the impact on any vouchers you have issued or will redeem. If you are redeeming a qualifying voucher post 1 July, it is likely you will lose 10% of the value of the voucher.
So I think that's probably particularly relevant for private individuals. So if you're hanging on to vouchers at the moment, you might want to consider redeeming them before 1 July.
On tax invoices, obviously you need to update your templates, credit notes, debit notes as usual. Margin, have you assessed how this will affect your margin? And lastly, competitiveness. How will you remain competitive with other GCC countries, for example, Bahrain and UAE, where VAT remain at 5%? What about your local competitors? What are their pricing strategies? Have you looked at them? Now, again, the current health crisis will also need to be taken into consideration when you look at all these factors.
And just before we jump to the next slide, obviously with the recent customs rate increase as well, when it comes to margins, you'll need to consider that. So if you're importing goods, you'll need to consider the duty rates and if they've increased on the goods that you're importing. So now we'll cover the financial services sector, which is arguably the most impacted of all sectors. We'll hand over to our financial services expert, Omar Hisham. Omar, do you want to take us through your thoughts on the impact?
Sure. Thanks, Mark. Right. So I think when it comes to VAT rate hike, now we've got to consider a few salient points from a financial services sector perspective. So the first one being the input VAT apportionment calculation. So what's the impact and how should it be calculated for the transitional period? That will be the two questions that will be lingering and people need to consider as they transition to the new VAT rate regime. Now, the attribution exercise is also now more important than ever, as any VAT inputs that cannot be recovered will mean that there is an additional cost to the business. If the current PE ratio is not a true representative of the business, probably it's now worth considering whether it's already time to apply for alternative apportionment method. Now, the next one will be in relation to the longer term contracts. How will you treat revenue streams such as insurance contracts spanning 1st July 2020? And for banks, annual fees for credit card that's charged to you on an annual basis, or trade finance related charges, and there's long-term commission charges. What are those impacts? So those are the streams that you will need to look at, whether the transitional rules will apply. Apportionment on the value of supply is very critical. Discrete supplies or one-off supplies that straddle past 1st July, if completed after 1st July, will be subject to VAT at 15% on the full value of the supply. Whereas on continuous supplies that straddle past 1st July, the portion that straddle past 1st July will be subject to 15%, and the portion before 1st July will be subject to VAT at 5%. So you need to understand how to apply the transitional rules mentioned by Mubin and Mark and Han earlier, and see whether how it's going to impact your business. Now, the next point is on insurance sector. The increase in VAT rate, as mentioned earlier, will definitely have an impact on the earned premium reserve, or UPR. Apart from this, where there are uncertainties as to the VAT treatments on certain supplies, it is better that clarifications are sought now, as this can turn up increasing cost of operations. For example, on brokerage commissions earned by an insurance company from sitting out businesses to overseas reinsurance company, there was a circular issued by GAZT in the year 2018 stating that the commission earned from overseas reinsurers will be subject to VAT at a standard rate and cannot be zero rated. So now businesses who were able to absorb or charge the 5% VAT previously may now face difficulties absorbing or charging onwards 15% VAT moving forward, right? So maybe it is time to consider whether it's worthwhile to seek for a ruling from the GAZT on whether the commission earned can be treated as a form of exporters, taking into account also that the GAZT had revised the implementing regulations for the zero rating or exported service conditions and apply zero rate on this commission instead. Now, on to the next one, Islamic banking. Will the 15% VAT rate impact cash flow on certain transactions? Certain Islamic finance transactions like Murabaha, Ijara, finance lease, where banks will acquire properties or cars upfront from the dealer and pay VAT to the dealer or supplier, and then supplying it onwards to the borrower, will need to charge VAT on such supplies. So when the banks acquire the goods from the supplier dealer, they pay VAT to the supplier dealer, and then when they supply it onwards to the borrower, they'll need to charge VAT on these supplies, right, and Islamic finance transactions. So now, usually, previously, VAT will be collected over a period of time from the borrowers, and VAT rate is 5%. The increase now will mean that there is potentially more VAT trapped in certain provisions of Islamic financing. Contracts after 11 May 2020, but cars made available on or after 1st July 2020 will now attract 15% VAT, even if the finance lease agreement could have been concluded and signed prior to the effective date of 1st July 2020. So now consideration will need to take you'll need to take into account on how are you going to charge that 15% VAT to the borrower, or banks will have to absorb this additional increase of VAT. Now on to the last point, regulatory restrictions. So one of the things that you'll need to consider will be whether SAMA is going to allow fee increase on consumer or retail finance products, especially where there are caps on the fees charged in the consumer market. So the additional VAT, moving from 5% VAT to 15% VAT, can you charge it onwards to the consumer? So this is consideration that you need to look, not just from a tax perspective, but also from financial services perspective, or as regulated by SAMA. So I guess that's about all. Passing back to you, Mark and Han.
Thanks, Omar. So along with financial services, the real estate sector is also hit hard by the change in rate, again due to the presence of exempt supplies for leasing of residential real estate. So the first question is, can you pass on the cost to the customer again? So for a real estate company, VAT at 15% will impact cost because the lease of residential real estate is a VAT exempt supply. There may be incorporation of hidden costs in the list price. So build-to-rent developers will be hit hard by the cost increase. Input VAT apportionment calculation. So how do you calculate your partial exemption ratio for 2020? Do you need to have two different sets of calculation? Is your recovery rate going to be impacted? Now, this again is relevant for those who are leasing residential properties. Advance payment. What is and are the VAT rates to be applicable if payment is received before 1 July, but services will only be delivered after? On retention, will your services have a 5% and 15% component? That will be very critical to identify.
If you're a landlord, you will need to look at your contracts. Can you increase the commercial rent to 15%? And can I increase my rent on exempt supplies to recoup the costs that I'm now incurring? Property prices will obviously be heavily impacted. So if you're in the industry, something to consider. And the capital asset adjustment rules, it's more about updating and maintaining the correct records. Now we'll touch on the oil and gas sector, and I'll ask on Omar to share his thoughts.
Yeah. So again, on oil and gas sector, the first one being the price increase. As we know, the fuel price in Saudi has gone down, but again, with the VAT rate, the fuel price for the consumers market will definitely go up than before. So we expect this to be increased on supplies made after 1st July 2020 though. Now on price hedging, prices agreed now, but delivery of goods made in the future, what's the impact? So this is the one of the things that businesses operating in the oil and gas industry will need to consider. And when you enter into all this forward contracts or future contracts where these contracts are attached to the physical delivery of goods, then you need to look at when the actual delivery of goods happen. If the actual delivery of goods is going to happen after 1st July, then it's most likely going to be subject to 50% VAT. Now, cash calls paid upfront for future purchases, operators paying capital contributions now to participating parties under a JV, for example, for future purchases, may see the capital value diminish, and because of the 15% VAT rate. So essentially what it means is that what you can buy after 1st July 2020 will be lesser than what you have forecasted before 1st July 2020 and before the announcement on the VAT rate hike. Swaps happening on 2 different dates. This is very common in the industry. Swaps of goods happening on two different dates will need to be assessed on a case-by-case basis in terms of, hey, look, if I were to swap the goods now with you before 1st July and you're returning the consideration you're giving me your goods after 1st July 2020, then what are the implications that you'll need to consider? Lastly, I think this has been touched before also by Mark and Han, capital expenditure, capital assets. Oil and gas sector tend to incur very material and substantial capital expenses, so it is worthwhile to assess whether there are avenues to advance certain purchases and delay some to manage your cash flow. All right, back to you guys.
Thanks, Omar. So the VAT rules differ obviously on depending on the industry you operate in. So the implications of the rate change will obviously differ. We obviously can't cover every industry, so we'll just highlight some other high-level points to consider in some other industries. So logistics, generally logistics companies incur a lot of disbursements on behalf of their client. So say, for example, importing goods, there might be disbursements for import VAT or customs duty that you want to charge. Obviously, the rate change will impact that because the import VAT will increase. So that will be a consideration. And tax coding. So logistics obviously operate in many jurisdictions. So you need to make sure your system can facilitate the increase in rate for the tax code as well. Exports, import VAT is a large cash flow impact for a lot of businesses, but especially for import exporters. So if you're not deferring your import VAT to your VAT return, I think the time is now to consider applying to GAZT for that concession. Disbursements again, so similar to logistics, the amount of your disbursements might increase as a result of the rate change. So again, a cash flow impact.
Just on the importer and exporter, you also have to consider your current bank guarantees that you have applied for goods that will be imported after 1 July. Because at the time when you apply for the bank guarantee, you probably assume that the VAT is applicable on 5%. Now that it has gone up to 15%, the bank guarantee value no longer sufficient. So you need to consider going back to your bank and amend the value. So a couple of points on consulting services. So for consultancy firms, you need to consider discrete and continuous applies. Take into consideration the new transitional rules. Input VAT recovery, you probably, again, this probably applies to all industry. You need to speed up your AP process to assess cash quicker. For healthcare providers, the cost will increase for private sector hospitals providing services to expats. Now, obviously not an impact on Saudi nationals as the VAT impact is nil. And lastly, on non-resident suppliers, for example, non-resident suppliers supplying digital services to unregistered customers. So question is, will the non-resident pass on the cost onto the consumers?
So this slide just briefly covers the GAZT amnesty, which is currently in force. So I assume most of you are already aware of this amnesty, which is GAZT essentially saying no penalties will be imposed if you make voluntary disclosures of errors or mistakes before 30 June 2020. So obviously you're getting ready now for the VAT rate increase to 15%. So if you haven't conducted a review of your VAT processes and systems since implementation or in a while, it's probably a good time to do it now. So you can kind of you can get ready for the VAT rate increase, as well as accessing this amnesty that GAZT has offered. But obviously time's ticking, you've got less than a month now to make that application. So you need to first identify any mistakes or errors you've made, covering income tax, VAT, withholding tax and excise, and then disclose them and pay them before 30 June. So not a lot of time. Generally, the GAZT amnesty is broken down into deadline extensions, which some of you might have already accessed, so you can lodge and pay your VAT returns later. There's penalty waivers, so if you've made mistakes, you can disclose them and penalties will be waived. If you're unregistered for tax and you should have been registered, you can register now and not be imposed penalties. You can defer payments of tax liabilities, so that's in line with the deadlines extensions. And there's other administrative measures, including allowing import VAT to be reported on the VAT return and not at customs. But again, you have until 30 June to take advantage of these measures. They are very widespread and advantageous to taxpayers. So if you haven't considered them, I really recommend that you do.
So what are some of the practical steps that you should be taking now? Look, you will need to consider the impact this is going to have on your financial position. This is especially relevant for exempt suppliers. What is the quantum of your blocked input tax, which is going to increase by 10%? How will your margins be affected? You'll need to update your ERP accounting system, including checking whether your system can hold dual VAT rates. Review your suppliers and purchases that span 1 July 2020 and determine the VAT treatment. Review your contracts. You need to really look at your VAT documentation, because you may having to do transitional invoicing to show both the 5% and 15%. So you need to be clear on that. Start your communication with customers if you already haven't started doing so, especially where you want to confirm whether they can recover the input VAT for pre-10 May contracts. Can you do all of this in-house, or will you need some external support? Look, there's not long to go, less than a month left. And there's a lot of challenges at the moment with COVID-19 and staffing as well. So you'll need to prioritize what is critical to get ready before 1 July and then do the rest during the July and August. As Mark pointed out, try to take advantage of the GAZT amnesty. There's again less than a month left. It's very important to take advantage of the GAZT amnesty, because if you don't take advantage of the amnesty, and then GAZT then comes and reviews you in 6 months and finds that you've made mistakes and or errors, they will fine you, and the penalties will be severe, because they would say, well, why did you not take advantage of the amnesty when it was given to you previously? So you should look at getting your VAT returns reviewed externally after 1 July, especially at least the first return, because at 15%, your penalties are going to be significant. What are we going to expect from GAZT after 1 July 2020? Look, an increased VAT rate means that GAZT is going to be increasing their audits and reviews, because they want to collect more money. So they're going to increase their scrutiny on businesses. Some businesses will lag behind with their readiness, so you'll need to be extra diligent to ensure your suppliers are getting it right. 15% VAT may also be significant enough to change spending habits for consumers. So Bahrain and UAE may take advantage of that, with customers being able to travel to Bahrain, UAE to purchase items. So it could be an impact on the retail sector as well. Now, we're going to move on to questions. What we're going to do is, the webinar is due to end at 11, but we're going to extend by 15 minutes up to 11:15 Saudi time, just so that we can answer as many questions as possible. So, and just a reminder that we're going to be running an Arabic webinar, the same webinar in Arabic, next Tuesday at 10 a.m. So I'll start going through some of the questions now. So the first question, will GAZT approve requests for import VAT deferral to the VAT return now that the VAT rate is increasing, because it will help businesses preserve cash? Look, we hope so. We hope that GAZT will start approving these requests for import VAT deferral. At the moment, at least until 30th of June, you can do a reverse charge. But any other thoughts, Mark, on that?
Yeah, I don't think, I mean, I don't know, but I doubt GAZT's processes have changed just because of the VAT rate increase. So I think it's business as usual for applications for import VAT deferral.
The next question I have is, we signed an agreement today with a government entity, effective date 15th of June and continue for 6 months. Should I charge 5% for 15 days and then 15% onwards? Look, assuming it's a continuous supply, yes, the supply that's being done pre-30 June will be subject to VAT at 5%. And anything after that will be subject to VAT at 15%. But remember, you cannot charge 15% right now. So you'll have to issue an invoice with 5% and then issue some transitional invoicing afterwards in July to cover that. Okay. Next question is, if a contract is for short term that is signed before the 11th of May, but the validity is for a year or two, will this be a short term, qualify for grandfathering? Look, I think this the person asking this question is getting at GAZT using the term long-term contracts previously under the grandfathering rule that came out in when VAT was first introduced. Look, it doesn't talk, the transitional rule now does not talk about long-term contracts or short-term contracts. It just talks about contracts entered into before the 10th of May or on or before the 10th of May. And the transitional period is basically up to 30th of June 2021. So provided you meet those conditions that are prescribed, you can apply the 5% VAT rate. I've got another question where if a land was purchased in February 2020 for development of a private residence, 30% of the value was paid in February with 5%, and the rest will be paid in August 2020. The deed is not yet transferred to us. While we have started design for the compound, the buyer is not registered in VAT being individual. Now, if you've got a contract that was entered into before the 10th of May, you need to meet the conditions. In your case, you will not meet the conditions because your customer is not registered for VAT. So VAT and a settlement does not take place before the 30th of June. If you do not settle on the sale before the 30th of June, you will have to apply VAT at 15%. Only any services that have been provided, but it looks like this is a sale. If there's any design services, obviously, if they were provided before the 30th of June, you could probably rate that at 5%, but anything after will be 15%. It's very, very important to look at the contract rule versus the invoicing rule and look at what you're supplying. Okay. Can I send a circular to my customers stating that I will charge VAT at 15% unless they confirm that they can claim VAT in full and the contract is signed before the 10th of May? I think the short answer is yes. So if you've got contracts with your customers signed before the 10th of May, I think you can send them a communication saying, please, you need to confirm whether you can recover the VAT, otherwise I'm going to charge 15%. Now, if the customer doesn't get back to you, you charge 15%. Now, we'll have to wait for whether GAZT issues any other guidance, but I think based on what's been issued now, you should be able to do that. If there is a contract for 2 years and customer issues monthly POs for monthly invoicing purposes, can I consider this to be a contract or monthly PO? Mark, would you sort of want to answer that one?
So you first look to the contract rule, which if you have a customer that's a business that can fully recover input VAT on that purchase, then you can apply the contract rule requirements. So the supplies up until either expiry, renewal, or 30 June 2021 will be 5%. So that's if the contract rule applies. If that rule doesn't apply, then you fall back to the invoice rule. So then you need to consider, when am I issuing invoices for services performed? So up until if you're issuing invoices on a monthly basis, then it's likely that from 1 July 2020, your supply will be 15%.
Just to add on to that, I think it's important that the PO that you issue on a monthly basis probably does not constitute as a contract. As far as contract is concerned, you will have to rely on your original master agreement or rate agreement that you mentioned. Okay.
Just a reminder that we're extending for 15 minutes to answer as many questions as possible. The next question I have is, will the transitional rule applied to purchase of services from foreign persons which are subject to RCM? Mark or Han, I think it's a quick answer for that one.
Yeah, I think you have to consider when the services is consumed by you. Ideally, if it goes beyond 1 July 2020, for a service that you have already purchased or paid before, which you have already accounted for RCM before, you probably need to consider charging or accounting for another 10% VAT on the RCM amount. This is because you are only consuming the services in the 15% KSA VAT regime, effectively.
So in effect, the transitional rules don't really apply to you. I mean, it's the contract rules and invoicing rules won't apply to RCM. You've got to account for it based on whether it's pre-30 June or post-30 June. Okay. If a customer cannot take a full input credit due to limitation of the law, how will it impact the supplier's responsibility to raise invoices with VAT at correct rate? Renewal of contract and amendment are different or to be treated as the same. For example, if the change in scope or value can be treated. Okay, so let me answer the first part of it. If the customer can't take a full input credit you need to get your confirmation. If you've got your confirmation from your customer that they can, then you can use the contract rule to charge VAT at 5%. If you don't get that confirmation, then you don't. Now, there will be some rules around GAZT releasing some guidance around, you know, what do you need from a customer perspective. But I think if you've got written confirmation from your customer, then you should be able to rely on it. In terms of what constitutes renewal and amendments, I think we've already covered that, and we can answer that separately offline. Sorry, next question. Is there any relation and consequence between custom fees increased in Saudi and VAT increases? Now, look, well, in the sense that, yes, if your customs duties go up, then VAT is on top of the additional custom duty. So obviously it's going to have an impact. So if you were previously, the customs duty was 5%, then you would have added 15% on the 5%. Now, if the customs duty is 10%, you're going to be adding. So it's going to have a compounded effect on pricing. I've got another question here. E-commerce businesses will find it difficult to comply with the transitional rules as deliveries will be done post-transition, which the customer initially purchased with 5% VAT on the website. Is it mandatory to deliver a revised invoice to the customer with different tax, even though we don't plan to charge the customer? Or can they just issue a tax invoice for the differential tax in their system and pay the differential tax? Look, I think before Mark steps in or almost steps in, what you will need to do, if you're making the supply, obviously, if you've got an order placed with you before the 30th of June, but you're not able to deliver the goods till after the 30th of June, obviously you'll need to charge VAT at 15%, very clear on that. Now, whether you need to issue a revised invoice to your customer, I think the short answer is yes, Saudi requires you to issue invoices, will issue invoices. Now, whether they need to be delivered to the customer, we had the same issue back when VAT was implemented. I think a lot of businesses just took a practical approach especially with retail customers, and not send the invoices out. Mark, do you want to add anything to that?
No, I think I agree with what you said. It's you just have to issue another invoice, unfortunately. I think VAT doesn't really care about the commercial realities of a lot of situations, unfortunately.
Okay. Will the VAT return form in the GAZT portal have options for multiple rates from July? Look, yes, we expect GAZT to amend the VAT return format. We expect them to amend the VAT return format to make sure that you can account for both. So we'll have to wait for GAZT on that. Here's a question. When should we generate? I think this is in relation to example 2. So you guys will just need to make sure you remember which one was example 2. When should we generate the additional transitional invoice for example 2? The question is, should it be done on 1 July 2021?
I think that's the tax point, right? So I think we just fall back to the normal rules on how to issue, on when you should issue a tax invoice, which you have up to the 15th day of the following month in which the tax point is triggered. So that's probably what I would look at. So if we say the tax point is the 1st of July 2021, then you have until the 15th of August, I guess, to issue it.
Yeah, and I guess in that case, for transitional purposes, tax point usually will fall back onto time when the goods or services were completed, just to make sure that you're raising the correct amount, just correct VAT amount before and after the cutoff date, as per the transitional rules.
Yeah, so if you're triggering it because of the 1 July 2021, then I think you've got till August. But if you're triggering it because contracts expired or there's a new renewal or another tax event, then I think you would just apply the normal rules for issuing invoices 15 days after that tax date.
One of the questions is, as per the tax invoice rules, an explanation is required to be shown on the invoice if a lower rate is charged. Will this apply when invoicing customers with a transitional rate of 5%? I think the short answer is yes. Look, we'll have to wait for GAZT guidance on this, but yes, when you're issuing transitional invoices in July, you will need to show some sort of explanation showing why is there part of it is on at 15 and part of it is at 5%, because I think from your customer will want that, and I think it from a GAZT perspective they'll want to see that as well, that there's some decision process that's gone on as to why that's being charged. Or true rates are being charged. Look, we're seeing a lot of questions on POs issued before the 11th of May and advance payments received and so on. Look, I think this is a complicated area. I think you've got to be really careful. You have to meet the contract rule. If you do not meet the contract rule, you've got to see whether you meet the invoicing rule, okay? So if you receive advances and you haven't issued an invoice before the 10th of May, then your advance, depending on what the advance relates to, you will not be able to apply the invoicing rule, okay? So I think you've got to look at this on a case-by-case basis. It's difficult to give blanket answers on this, so we recommend that if you do have specific questions around issue dates of POs and contract dates and advance payments received, please email us and we're happy to look at those questions for you. Advance paid before, again, I look at this advance one, I'll skip to the next one. Again, a lot more questions coming about what is treated as a contract revision. Again, look, we recommend that you look at it on a case-by-case basis. If you've got a contract signed before the 10th of May, I think you need to look at your contract terms to work out whether the question whether the change you're making to the contract makes it a new contract or it's a contract revision. So I think it's a case-by-case basis answer. You need to look at to work out whether there's a contract renewal or not.
On the contract point, I think it's a legal question, right? So you go back to contractual principles as to when a contract is either expires or is renewed from a legal contractual point. So it's difficult to say. I think, yeah, as Mubin said, it's really based on the terms of the contract and what's an essential term. So it goes back to basic contract principles.
Yeah. We've got another question, which is how do we deal with invoices issued continuously in contract? Do we apply contract rules or tax invoice rules? Okay, look, you always apply the contract rule first. If the contract rule does not apply in your situation because it's a B2C supply or a B2B where your customer cannot recover the input VAT in full, you then look at the invoice rule. Okay, so that's what we do. If a contract to provide transportation services is made by a logistics company for a year before the 11th of May and services provided in subsequent month, what rate should I use after the 30th of June? Will it fall? Well, look, if your contract is signed before the 10th of May and you meet the condition and supply is taking place up to the 30th of June 2021, you can use 5%. Import bayans are without VAT these days. Where import invoices to report in VAT return, or I think where should we report import invoices in the VAT return? Han, maybe you want to try to answer that one?
Yeah, so on importation, it is important for you to consider when the goods are coming in. One of the things that businesses may have an issue would be import of goods that will only come in after 1 July 2020. So in that case, you will have to pay 15% VAT upon importation. And another good point raised by Mark earlier was on the raise of customs duties. So if your goods are affected by customs duties, you will need to consider the additional payment that you need to make. Look at your bank guarantee, your letter of credit to see if the amount that you have guaranteed is sufficient to pay your goods, because if it's not, again, the goods will not be cleared. You will have to incur demurrage charges from authorities, storage fees and all that, which will form a huge cost of business.
There's a question on, could you explain with example how we should apply the 10% VAT? Well, just to clarify, you're not applying 10% VAT, you're applying VAT at 15%. So your transitional invoice basically will show VAT on the supply at 15%, and then you will have to show what has been charged at, what has been charged previously, what has been paid previously, and the balance owing. The person who's asked the question, if you want to contact us directly, we're happy to guide you on that issue. Look, we've got another 4 minutes to go. So look, there's still a lot of questions around the contract rules, the invoicing rules. I think, as I said, you've just got to look at the each rule separately and then assess which one applies to you. And again, on renewals and so on. One other question is how, well, it will not be practical for prices to match on 1 July immediately. It will take 2 to 3 days for a retailer with multiple branches, with GAZT let go in the first few days. Now, I think if you go back to when VAT was first introduced, I think UAE, for example, allowed up to 7 a.m. or 8 a.m. on the 1st of January. GAZT did not allow any sort of such leeway. They basically said that anything after midnight had to be charged at VAT at the new rate, at 5% back then. So I think unless GAZT, we'll have to wait to see whether GAZT issued any guidance on this, but you will need to basically make sure that you shut down on the 30th of June at some stage, spend 3 or 4 hours changing all the prices, updating your system so that you're ready to go at whatever time you open on the next day morning, so that you can charge at 15%. I don't think GAZT's going to give any leeway to businesses or 2 or 3 days. Again, but we'll have to wait for the guidance to be issued on that. So hang on, any more questions? I mean, okay, this question, if contract was made by means of letter of credit before the 11th of May, one of the major terms there is a delivery of the materials with breakdown as 50% on this future date, 30% on this future date, and then 20%. Will it be considered as a continuous supply?
Can I answer this?
Yeah.
Right. So usually when you enter into an LC contract, it's for international trade. So when it comes to an international trade, then again, the movement of goods will be your primary focus. So regardless when you do the delivery, if it passes through Saudi customs 1st July onwards, it will be subject to 15% VAT.
Okay. Look, I think that's all we have time for today. Thank you very much for joining us. A reminder that we have the Arabic session next week. If your question remain unanswered, please feel free to send us an email, and we'll do our best to help you with your unanswered questions. But with less than 30 days to go, we recommend that you really get started to get ready for VAT, because GAZT is going to take, I think, a serious approach to applying penalties 1 July onwards. Thank you very much for joining us.
Thank you, everyone.